Okay, now we're going to finish up this lecture by talking about some specific types of loans that you might encounter both on a personal basis and that are important on a corporate basis. Remember, loans are types of annuities. And the very next chapter, chapter 7, we're going to spend a lot more time talking about corporate loans, corporate debt. And these are types of annuities that we're going to talk about. Okay, so annuities typically in this context is referring to loan-like contracts. And we want to talk about some specific ones. So we're going to talk about 3, but there are tons of different structures of loans with different rules than these, loans that have different payment structures than these. These are just the most common. Okay, so the first thing we'll talk about is called a pure or a discount loan, which are really the most common types of loans that governments take out. Then we'll talk about an interest-only loan, which is really the most common type of loan taken out by a business. And then we'll talk about what's called an amortized loan, which is the most common type of loan taken out by an individual. Okay, so different kinds of loans for different entities, people, governments, and companies. And I just want to give you a brief overview of these things. Again, we are mostly going to be interested in the first 2 because we're mostly talking about corporate finance. But I do want you to be aware of the last type, the amortized loan. Okay, so a pure or a discount loan. So they're sometimes called pure loans. They're sometimes called discount loans. Again, terminology in finance can be confusing, but it's part of this class to try and learn it or at least be exposed to it. So people will use these terms interchangeably. A pure loan or a discount loan is a very simple structure. It means that you borrow today and that you make all of your payments at the end of the loan period. Okay, so there are no intermediate payments, there are no interest payments, there is no money changing hands except for the amount of money that you borrow and the amount of money that you pay back. So because of this, I mean, imagine, for instance, just before we talk about what a government does, imagine that was the kind of loan you needed to do to buy your house. Like, here's how it would work. I want to buy a house for $200,000. I go to the bank, they give me $200,000. I make no interest payments, no principal payments. I pay nothing back for 30 years. And then after 30 years, I come back and I pay all of the interest and all of the principal at once, right? Imagine how impossible that kind of loan would be. Nobody would take it. None of us could do that. Right? Even if we were smart and diligent, it would be too much temptation. No bank would ever be interested. Governments, however, this is the main kind of loan that they take out. Okay? So the US government has it's usually a specific structure. So for instance, when you loan money to a government, usually what you do is they tell you the amount of money that they want to pay you back. So they say, we're going to pay you back $100,000 in 1 year, and we will pay you 5% interest. And what you do then is give them the present value of that amount as the loan. So you say, okay, and here's the problem. We're not going to work it. You can work it. Check it on your calculator. Here's the problem. You say, okay, we want a loan that we're going to pay you 5% for 1 year. We want the result to be we pay you $100,000 at the end. You say, okay, I'll loan you the present value. So you loan the government $95,238.09. You earn 5% interest over 1 year, and they pay you the entire sum back as $100,000 at the end of the loan. Okay? Now, government, that's easy for them to do. Why? They just print money. So if they have to pay you back $100,000, they just collect taxes, they pay it back. The other thing that they have the ability to do that we don't as individuals is they can borrow money from someone else to pay you back. So if they owe you $100,000, they can just turn around and borrow it from your neighbor. And then they can use that money to pay them back, and then they can borrow it from somebody else to pay them back, and we can just keep the whole thing snowballing. Okay? This isn't an option that most individuals have, and so discount loans are almost exclusively government loans, and you almost never see them in a personal context. Certainly, I would never want to be a part of it for my own self. Okay? But we will talk about government loans and bills more in the next chapter. Okay? The second kind, and this is the kind that's really the most common kind of business loan, is called an interest-only loan. And an interest-only loan is a loan where the only intermediate payments you make is the interest. And then you make all of the principal payment in one lump sum at the end of the loan. So again, think about what that means. That's not a structured loan. that you would want to take as an individual. If you bought a house for $250,000 and an interest-only loan, let's say 4.25% interest for 30 years, that's a pretty good loan for a house, right? An interest-only loan would mean you would only pay the interest payments every year. So every year you'd pay $10,625. And then at the last year, year 30, you'd have to pay all of the $250,000 plus your last interest payment. Again, not something I'd ever want to be a part of, because you're going to have to come up with and save all of that $250,000 on your own and make sure that you never use it for anything else, right? No bank is going to trust you with that, certainly. And most individuals probably can't handle it. Let's be honest, we all splurge a little more than we ought to. So this is the kind of loan that a company will take out. However, companies just pay interest on their loans, and then they pay all of the principal back all at once. But companies, again, they have a benefit, just like governments. Companies can borrow more money to pay off their old loans. So companies typically do what's called revolve their loans. And revolving loans are those that they take out and then they take out again to pay off the old one, and then they take out again to pay off the old one, and they take out again to pay off the old one. And so they just always have an outstanding loan, and they're always just paying interest on that loan. And that's just not something that's really available to individuals. But when we talk about bonds in Chapter 7, which bonds are corporate loans, this is the main thing that we're going to be talking about. This is the structure. Finally, the kinds of loans that we can get as people, they are called amortized loans. And an amortized loan is probably one you've already gotten if you have a credit card or if you have a car loan. If you have any student loans, all of those are amortized loans. Okay? And an amortized loan comes in two flavors. The first one is called a fixed principal payment. And this is the least common. But a fixed principal payment means that, first, with an amortized loan, you make a series of payments over the life of the loan that is part principal, meaning part what you borrowed, and part interest, part what you are paying the bank for the right to give you the loan. So the combined payment is some part of the loan being paid back and some part of the interest being paid back. Now, a fixed principal amortized loan means that the amount of principal that you pay is fixed. It's fixed forever. So you pay $1,000 principal every month for 30 years. And what changes is the amount of interest that you pay. So a fixed principal payment has a changing total payment because the amount of interest fluctuates with the life of the loan, and the principal does not. Okay? Now, these aren't that common. In fact, the most common type of amortized loan is the next flavor, called a fixed payment. And a fixed payment is a fixed total payment, meaning the total amount that you pay to the bank every month is exactly the same, but the proportion of principal and interest changes over time, right? And it changes over time in a very specific way, which is to say that you start by paying mostly interest and just a small amount of principal. And then over time, the interest shrinks, but the principal gets larger. And then by the end of the life of the loan, you're mostly paying back what you borrowed, and there's very little interest to pay back. Okay? So there's an Excel example here. I have an Excel spreadsheet on the As You Learn page. It has an amortized loan spreadsheet for you, so you can look and see how this works. I encourage you to go look at it. Of course, I use one when I bought my house. I use one when I bought the car. When I bought my car, I like to look at it and keep track of what all the payments are, how much interest is being paid, how much principal is being paid. Now, I'm a finance professor, and so I care about that kind of stuff, and you might not, but certainly you should care about your finances in general. And if you're making commitments as big as those, you should at least know what all of the underlying payments look like. And this Excel spreadsheet is yours. You can do whatever you want with it, and you're welcome to keep using it. Okay. Now, all of the things that we've done in our calculator can be easily done in Excel. So again, some of this class is going to be an introduction to Excel. There's an Excel project that you're going to need to use some of this stuff on. So I encourage you to start getting used to Excel if you haven't already done so. These are the function names for the present value, the payment, future value, the in, and the IY, so number of periods and the rate. So this is how you would solve for any of those problems in Excel. You would type equals and then type your formula, and then you would be off to the races. Okay, so if you don't have any experience with Excel, again, please, I urge you to go to the Microsoft website and just take their free online Excel course. It will introduce you to how to use functions and drag and drop and all the kinds of stuff that will make you just so much easier in this class, but also just so much better of a candidate in the job market. Okay? And these are the problems that we worked in the last chapter. So you already have all the answers to these problems. You already have the solutions using the calculator. I want you to go and use Excel to solve all these problems using these functions. Okay? So take 10, 15, 20 minutes, or if you've never used Excel, go take an hour and do the free Excel course on Microsoft's website, and then come back and solve these problems and show yourself that you can, because this is a good start for when we have to do the Excel project later. Okay, that's all I got for chapter 6. Again, chapter 6 and 5 are pretty similar. There's the material there is not a lot of different. This is also the end of the material for the first part of the class. So this is what your first exam is going to cover. It's just going to be 2, 3, 5, and 6. You're going to see the review go up here this week for the first exam. So keep an eye out for that. The review is going to be in 2 parts. It's going to be a blank sheet with just the questions, and then the sheet with all the solutions. Again, just like with the homework problems, I really, really encourage you to try to do the review without looking at the solutions. That is the only way that you're going to know whether you're ready to take the exam, is if you can do the review without the solutions. So do the review. Anything you can't do, just put a check mark on it. Then you can go study, or you can send me an email, or you can come talk to me, and you can get extra help on the things that you don't know how to do. But if you're using the solutions as a crutch, you won't have any idea what you know. And when you come time for the exam, you won't have that crutch there to support you. Okay? So great. Well, this is it. The next chapter is chapter 7, and that'll be the next module. So good luck on the exam, and we'll see you next week.